Welcome to our June economic update. This is a concept we're probably all very familiar with from a retail point of view. You've had some profits during the year. To lower your tax bill on those profits, you can sell a few things that are trading at less than what you bought them for and reduce your taxation bill. Often we see this selling coming into June for retail mum and dads like you and I. But institutions also indulge in this practice. As we move through to May and June, these are often the weakest months that we see on the Australian Stock Exchange. Institutions are trying to divorce themselves from bad investments. If they sell all those investments before the 30th of June, then when they print their accounts, those bad investments will never appear in their books. So a lot of institutional tax loss selling begins about the middle of May and finishes around the middle of June. What this means for share market prices is often stocks that haven't performed very well during the financial year get an extra thumping as we go through May and June. These extra thumpings can be quite harsh, a lot more than 10%, sometimes 40% or more. But under the buy and sell volume examples that I just gave you in our Appendix 5, how the pricing actually works, once that heavy share volume passes, that heavy selling volume, you often see large price rises that comes through in late June and feeds its way through July and August. And this is just bargain hunters coming in, picking up very cheap businesses that have been well oversold compared to what their business is actually promising in the future. So July is often the second best to best month that actually happens in the Australian Stock Exchange year. There have been some analysts and market commentators that have said that those shares that have had a reasonable fall in May and June can often bounce back between 15 to 40% or 13 to 20%. It depends how far the share price has fallen. The other thing is, if institutions or retail people are trying to do some tax loss selling, the liquidity of the stock, that's the amount of volume and value traded every day, has a big effect. The more illiquid the stock, the bigger the fall. The more illiquid the stock, the bigger the bounce back. These are the things that we'll be watching for you as we move through July and August. Just as a bit of a demonstration, if you like, in these tax loss selling periods by institutions, there was an article I pulled out of the Australian Fin Review just recently on Adairs. Adairs is a bedding and sheet business that operates solely within Australia. There was a lot of selling in the Adair share price. There was a lot of institutional selling. You can see on the graph here, it's fallen from about $1.40 down to a low of about 53 or so cents. At that point, there was a large crossing. The final two institutional sellers finished their selling, and on a single day, that share price bounced back up 47% in a single day. And it's actually moved higher since. So a very good example of tax loss selling, a very good example of heavy selling volume, taking the price of a business down and it having a bounce back once that heavy selling pressure has been lifted. Once again, another great example that price does not equal value in a share market in short periods of time. Coming to the investment philosophy that we have and why we put out these economic updates in the first place. You can see on the screen in front of you, we feel that economic forecasts happening in the various economies around the world actually drive particular sectors and thematics that can take advantage of those economic moves. An aging demographic, for example, in a particular country, may be a very positive economic fundamental that can drive the earnings of aged care or healthcare businesses in a particular nation or on a particular bourse. We also feel that if the underlying economics changes around the world or in Australia, that any of our clients would reasonably expect that our portfolio construction and our investment opportunities would change. And that's why we put out our quarterly economic update that supports our investment philosophy. Where are we currently sitting in the economic cycle? You can see in the picture in front of you that we're sort of hovering on a cusp between defensive growth that favours the bond market and bond proxies, and a recovery that favours cyclical growth and particularly equities. We actually have been hovering on this cusp for a very long period of time, and it's created a lot of volatility in markets. Every now and then, the market will get excited about the future economic growth coming through the world, and a lot of money has been moving into share markets and into cyclical growth stocks. Then every now and then there's a setback, whether it's a bad inflation number, it's a bad growth number, or there are growth concerns, and we see large pullbacks in shares. And we've been hovering here for quite some time. You can actually see this in trading in the Australian Stock Exchange over the last 3 years. The last 3 years generally has not seen any growth in capital value in the Australian share market. On the graph in front of you, as soon as there's global growth concerns, as soon as there's a currency concern, then you will see the share prices being knocked back. That's what happens when we're on the cusp. It goes back to more defensive investments, money runs back into bond markets, money runs back into bond-like proxies. As soon as the market takes the view that we are going to move ahead into a recovery cycle, which does favour shares, you'll see the markets bounce back up again. It's a cat and mouse game that we've been playing for 3 years now, but we do think we are very close into making a solid move into the recovery phase of the global economic cycle, and we have been preparing your portfolios for that. We can see in a lot of the indices, economic indicators that we follow around the world, things are getting better. There's definitely been an improvement in fundamentals as it sits out there. Inflation has been moving up in major areas like the US and in Europe, which is very good for earnings for business, and unemployment has been moving down. We've also seen a rise in bond yields, which is an indicator that better growth and economic times are ahead. Industrial production numbers too are moving up, and in some countries reaching 5 or 6 year highs. That's very exciting from a growth perspective. So there's a very positive outlook for some of the more growth businesses or growth sectors that we have out there. One of those leading indicators is the Purchasing Managers Index that we can see that's reported by major economies around the world. China, Europe, the US are all positive indicators. In fact, some of them are making GFC highs. Other statements, like from US President Donald Trump, that they're going to be involved in large infrastructure spending. Similar noises have been made from China. All these things are very positive for cyclical and global growth. Very good indicators for employment, very good indicators for commodity usage. Generally also, in many of the Asian economies, the news has been very positive. Exports have been increasing, imports have been rising along with that, inflation's been moving very positively. Global growth looks like it's coming through, and we will move into that recovery phase shortly. The other thing that we're seeing out there is consumer and business indicators. So business sentiment in major blocs, the EU, in the US, also in the UK, have been rising to post-GFC highs. We're also seeing consumer sentiment rising. Along with that comes an increased retail spend. And I've talked before in economic updates how extra dollars spent in the economy often cycle their way through an economy 8 or 9 times. So you buy an extra coffee, the coffee maker has more money, they buy an extra t-shirt, the t-shirt retail salesman has extra money, he holidays at the Gold Coast, the tourism operators down at the Gold Coast, they have extra money. You can see that spending cycles its way through an economy many, many times, lifting profits, lifting business, creating more employment, creating more positive things for the economy. That's what we're looking to happen globally very soon, improving fundamentals. What that also means out there is global bond yields have bottomed. We've spent a lot of time in the past explaining bond yields, explaining how generally they are an indicator of future growth and future inflation in different economic blocs. Here we see the global bond prices bottoming out in 2016, and they lifted quite extraordinary with the election of Donald Trump. Since then, we have seen a small pullback, which has been against our expectations of what would be happening. But we still feel those bond yields have seen their bottom, and that we'll see rising bond yields over time, which will be indicative of rising economic growth over time. As those bond yields rise, the price of bonds fall. And part of the big rotation from bonds into equities comes from holding that as a long-term view. Monies feed their way out of the bond market, which is over 7 times what global share markets are. If you add up the market capitalisation on every bourse around the world, global bond markets are 7 times that total size. So even small inflows from the bond market can create large rises in equity markets. And this is part of what we're looking for by rising into the recovery phase of the economic cycle and moving out of this cusp part where money keeps running backwards and forwards, frightened by global growth prospects decreasing, back into defensive bond proxy-like investments, excited about global growth prospects, running back into cyclical stocks and share markets. We've highlighted that we feel that US interest rate rises will keep going down a path that Janet Yellen has provided to normalisation. Recently, in June, we had the 4th interest rate rise in the US economy. Janet Yellen is preparing us for 8 more to go. A 3% neutral target, which is what the US is setting themselves as normal interest rate policy, means another 8 interest rate rises. We're expecting another 1 to come through in 2017. We expect at least 3 more in 2018 and at least 3 more in 2019, with another 1 to come in 2020. We actually feel that this is the slowest movement of interest rate hikes coming through in a positive US economic cycle. And the rising of interest rates in the US economy has major implications for global bond yields continuing to rise. And once again, that favours the recovery and the cyclical growth side that we've tried to implement into your portfolios. The Fed's funds rate is what we feel is a bit behind the curve. If really positive US growth starts to come through, then we feel the US may have to raise interest rates even faster, especially as we go through 2018. So we will keep monitoring this for you. We said the US would be the first to start to raise interest rates around the world. We said most of the other world's economies will follow. We do believe Australia will follow these interest rate hikes with about a 12 to 18 month lag. So Australian interest rates have a very close correlation with US interest rates. Thus, Australian bond yields have a very close correlation with US bond yields. And that's why the red line and the blue line stick so closely together as we've moved through the last 20 or 25 years. So we keep emphasising this point because it's been a long time that interest rates have kept decreasing for, and we know that investors are being very complacent when it comes to pricing in interest rate rises and what it means for some sectors of the stock market. Those sectors, as we've highlighted before, that form what we call the bond proxies, they have yield characteristics very similar to those of bonds and don't have a lot of growth in them. They've been very well supported as interest rate rises have fallen and bond yields have fallen over the last decade to 2 decades. We really feel as cyclical growth comes in, as interest rates continue to hike, and as bond yields start to properly reflect this, that those bond proxy areas of the market will see their share prices fall as money starts cyclically rotating into the growth side of the share market. And that's where we've positioned you. Obviously, if bond yields start falling, as they do, as we cycle in the short term, then we see a reversal of the money flows because we've been sitting on the cusp and money runs out of growth stocks and back to the defensive growth stocks and bond proxies. So we have seen a lot of that cycling as we've gone through the 3 years. But as we've pointed out, we feel we are getting closer and closer to share market growth and cyclical growth in the recovery phase. The other thing that we've started to see is the US quantitative easing program and an official timeline and guide on how it is going to be wound back. So part of that bond yield market, that bond yield information that tells markets whether growth is coming or not, is being suppressed by the $10 trillion that sits out there in the central bank's bond buying program. Currently, central banks are adding $2 trillion a year, buying bonds around the world, purposely trying to keep those long-term interest rate expectations low. That was their plan all along. The US has now said, we've done enough of that. It's time to wind this policy back. So starting in about September, instead of when a bond matures, like a fixed interest note matures, instead of reinvesting all that back into the next bond, they are going to start cutting back that reinvestment. And they will cut back by $6 billion a month. So if they're rolling over $40 billion during a particular month, they will only reinvest $31 billion. They'll see how that goes, but every quarter they plan to pick that up, if all things look fine, by about $6 billion a quarter until they get to about $30 billion per month not being reinvested. And they'll stay there at that rate for some time and keep reassessing. In the mortgage bond market, they're going to do a similar thing. The numbers are a little bit smaller, but eventually they're going to work around to $20 billion not being reinvested into bonds. That's $50 billion a month that will be cut back and wound down. So that long-term bond yield suppression, that heavy weight, that $10 trillion with another $2 trillion being added per year, is going to start to lift, and bond yields will rise with it. So Quoting Warren Buffett, it's important to recognise that the investor of today does not benefit by yesterday's growth in the businesses that have done extremely well under artificial bond yield suppression. And once again, that's the reason why we have begun the cyclical rotation of your portfolios into growth cycle shares and investments. We also, incidentally, really appreciate your fixed interest notes that are purposely floating rate interest rate notes, so that when interest rates in Australia do start to rise, and we wouldn't think that that would happen until well into 2018, but every single interest rate rise will add immediately to the distribution rates of your notes. So we have positioned you for this. Our growth key market themes for equities are sitting there in front of you. You can see that we are really going to favour those cyclical growth areas where we think there will be economic tailwinds in a world of rising bond yields, in a world of economic recovery globally. So some of those themes you can definitely understand. With larger growth around the world and more consumption of goods and products, we expect that the material and resources sector would be doing very well. With an outlook for an Australian dollar, which we do think will fall from the current levels, we think there will be booming inbound tourism that will help a lot of Australian businesses. Obviously, with the digital revolution, everyone moving to iPhones, businesses moving their businesses into the cloud, there will be a surge in demand for businesses that operate in the digital marketplace. So we are looking at those growth areas. They're the sorts of investment recommendations that we have that are bringing to you and that we will continue reporting on. So just summarising this particular piece, please be aware we haven't left the cusp area yet. The market takes any small short-term negative data as a setback in what is happening in the global economy. This will take patience. We have also raised cash levels generally in portfolios because we expect further volatility, further up and down movements in share prices as the volume of buying and selling constantly switches between growth and being defensive. We actually think the markets continually overreact to very short-term pieces of negative information. Generally though, we are aware and we do feel that the Australian share market is slightly overvalued. So we do want to use our cash balances on any pullbacks to pick up some of the good future business growth opportunities that we see happening over there. The last point is the US is a brilliantly large economy operating at multiple speeds. And to have the world's largest economy growing so strongly, to have employment come right down, we really feel that's going to drag the rest of the world, including Australia, along with it. So there's quite a lot of reason to be positive about the next couple of years. So moderate your expectations of returns in the short term and keep calm. Gradually, we're going to be reallocating our monies in our equity strategy towards those growth stocks. In doing that, we cannot be complacent about some of the businesses that have been very kind to us in the past. Just because they've performed well in the past does not mean they'll perform well in the future. We're going to concentrate our investments in areas where we have high economic conviction that we think the tailwinds will push their share prices forward. We also feel that internationally, in Europe, in America, in greater parts of Asia, there represent more opportunities for growth in the near term. It will be some time, there will be a lag effect before it starts to drag the Australian share market along with it. Diversifying internationally is very important to us. A quick review for for you of the major global indices and how they performed during the 2017 financial year. Pretty much they were sitting very flat until we got through to the election of Donald Trump on the 8th of November. The blue line indicates the Australian share market. You can see a small rise, but not very much during the financial year. The red line is the S&P 500. The markets that clearly benefited were Europe, represented by Germany there in the green, and also Asia, represented by Japan sitting there in the brown. These economies are doing very well. We are seeing that pickup in growth, those purchasing manufacturing indices, the business confidence, the consumer confidence. Growth is starting to build itself into the share market. The bottom grey line there has been China. Once again, China is a very immature share market compared to some of the other foreign share markets. Most foreign share markets are at least 85 to 90% institutional controlled. The Chinese share market only has about 10% of institutions. The rest of the share price are controlled by the retail public. So although the Chinese share market there has been very flat, we don't find that that's a very good indicator of the economics of how China is going and how the future growth for China actually looks. But we think Australia will continue to follow the positive lead from the US. Coming back to our own bourse and ripping that apart in some further detail, you can see over the last 18 months or so, the micro caps, the small end of the sector, and this is where Contango, one of our listed investment companies, operate, has had incredible outperformance as we move through 2016. That green line up the top, which follows the micro cap index, vastly outperformed. As we've told you a couple of times, there were some larger cap fund managers that had small cap mandates in the market. Some of those were lost in November of 2016, and a couple of big ones of those were lost in February of 2017. And we saw a lot of selling. Losing a mandate means that the $1 billion that you might have been given by a super fund has to be sold and paid back. So once again, we've seen a lot of volume of selling coming into the Australian market, particularly at that smaller end. You can see that drop in that green indice being quite stark compared to other indices. So our portfolios were performing quite well coming into the September and somewhat into the December quarter of 2016. But as that microcap exposure through CTN and others, as that fell away, we have seen some underperformance as we came into the March and the June quarter. I do not think that will last. We'll see that bottoming out now. A more positive Australian economy, a more positive growth economy is actually better for the smaller business end of the Australian share market. You can actually see the mid caps in the red, the micro caps in the green, and the small caps in the brown on those indices in an 18-month view have performed a lot better than the top 20 indice, which is there in the blue. And we think that that will continue. Obviously, though, with those mandates being sold down since February, we've seen some underperformance at that smaller end. But we think that that will be caught up as we move through the remaining months of 2017. Also, the experience from the US economy, which we're very positive on, which we think growth is going very well, the small Russell 2000 index has outperformed by a very significant amount the broader S&P 500 index. We have recorded an educational fixed interest video for you that explains what fixed interest is, what it does, how it's priced, and I've put that on the screen for you to click on or to copy into your browsers. Please, if you're not experienced with fixed interest or you would like to know more, we implore you, I think it's a very good idea that you watch that educational video. Coming back to our fixed interest strategy, we do believe there will be some new fixed interest issuance coming up over the next couple of months, which we'll keep you informed about. I would like to say though, in past strategies over the last year, we said that some of the lower margin notes would fall away and that the higher margin notes, that their prices in the market would be supported. And that's definitely been the case. The high margin notes that represent the bulk of our portfolio have done exceptionally well. Not only are they paying you the largest distribution rates that are available in the market, but their prices are being supported well above the $100 note mark. We are aware though that some of the lower margin notes have fallen back to very attractive prices. We can buy these notes. There are very good distribution rates available, and if they're trading below that $100 mark, when they get called back by the blue chip institutions that we look at, there will be a small capital gain for us also. So we do have a slight change in strategy, and we are looking for opportunities there in some of the older notes. As always, banks issue 85% of the notes in this space. We really value the diversification of finding notes that are issued by non-bank issuers. We always monitor very closely the sorts of trigger points that we would use that would indicate to us that we need to sell our notes. I've got them triggered on. We keep a very close look at property prices because banks do issue 85% of the notes in this space. We take a very good look at what government bond yields are doing. Were government bond yields to rise very significantly, then that may mean that they would then represent better value and a better distribution yield for the risks that would be taking. So we're constantly monitoring that. Also, the types of institutions that we have fixed interest coming out from, once again, we try and make sure that they have very strong balance sheets. And if anything were to go wrong with their businesses, that they could raise equity very quickly. Shareholders protect us as note holders. The more willing shareholders are to give these corporates money, the better the protection to us as a debt holder in the company. It's something we monitor very closely. Finally, my last slide, just wanted to look at the US market very quickly. So Trump's come up with packages of infrastructure stimulation. That's very positive. Trump has come up with packages of tax cuts. Extremely good for business if we think they're going to retain another 15% or so of their earnings through tax cuts. Put that on a price earnings multiple and take that out 16 years. That's a very large lift in valuation. Markets have started to price that into shares already. It's already sitting there. But we feel that there will be some difficulty in passing this legislation through both houses of Parliament in the US. As those packages are brought into Parliament, and if they're knocked back, that will create quite a scare for global markets, and there could be pullbacks. So we think the US economy is doing very well. We think those economics will drive large profit and revenue increases for not only US companies, but global companies. But we do think US markets are overvalued, and any scare on the legislation side could see to a retracement, which we would happily take more US exposure in. So that passage of that legislation going through US markets could create some volatility. Thank you very much for your time.